Okay then, shall we make a start? Because the initial part's the introduction. So, hello everybody, and thank you for joining me today for the Sustainable Footprints Streamline Energy and Carbon Reporting Workshop, otherwise known as SECR. So, the objective of today isn't just to present at you, but to look to engage with you and give you confidence in how SECR's going to work and how you're going to manage your compliance activities. How we're going to start this is with an initial presentation where I'm going to go through a couple of elements of SECR, and then what we're going to do is we will open the floor and get your questions, your feedback, any queries you may have. Just for housekeeping, if you can keep your mute buttons on, and if you have any questions, just submit them in the chat, and Hamza or Claire will pick these up as we get going. So if we can, we'll just start off with the presentation now. Oh, the presentation's just disappeared from the screen. Sorry about this, guys. Just waiting for the next slide to come up. There we go. So first of all, I'll start with a quick introduction in Sustainable Footprints. Promise this won't be that long. So Sustainable Footprints was founded in 2009, with the primary product at the time being a robust, standardized organizational carbon footprint quantification and analysis service. We also looked at carbon reduction strategies and looking at where standards and ISO were moving. Since then, we've not only grown in size, but also in breadth of product offerings to our clients, including energy efficiency surveys, ISO management systems, support services, compliance and risk services, provision of training, and a number of tools such as our SendCalc, which is something we're quite proud of. Our UK team brings together more than 300 years combined experience, and our consultants are not only experts in their field, but they're also very passionate about their subjects and our own clients' performance. In short, our clients' compliance and deliverables becomes ours, and we take a lot of pride in this. So anyway, that was the brief introduction to Sustainable Footprints. Now that's out of the way, let's move on to SECR. So SECR, the Companies Act 2006 Regulations 2018 Amendment, came into force on the 1st of April 2019. That requires all qualifying organisations to disclose their annual energy use and GHG emissions for activities for which they're responsible. In addition to the absolute energy and greenhouse gas emissions, organisations should include at least one intensity ratio and energy efficiency actions taken within that reporting period, and an outline of the methodology used. Organisations are encouraged to ensure that all information is aligned to their financial years to aid comparability and consistency of information across reports for the organisation. And it also makes sense when you're trying to get buy-in and get people to understand how they're performing if they're comparing apples with apples. The objective of the SECR statement being that readers of the emissions data should have a clear annually comparative understanding of the organisation for which the emissions data has been reported, and how it differs from the operations of the consolidated financial statement. The key thing to be aware of here is deadlines. If your reporting period was April to March and you applied for the COVID extension last year because of the pandemic, you must submit that financial statement, including the SECR statement, to the Companies House by the 31st of March 2021. So we're now at the end of February. This means the clock's ticking. If you didn't apply for the SECR extension, for the COVID extension, and have already submitted your accounts without your SECR statement, you will need to do this retrospectively as an amendment. This is only if you qualify, and we will go into qualification a bit further on. So if your financial year end follows a calendar year, January to December, you then have up till 9 months following your year end date to submit your financial statements, including the SECR statement to Companies House. So as you all know, late or incorrect filing can result in fines or your company being struck off the register. But another thing to bear in mind is your director's report is downloadable from Companies House. We often do it when we're doing ESOS. We download everyone's company's accounts to see where they're at. So this is the public perspective of you. It could negatively impact it if you haven't got this in there or it's done right. So how do we assess if your organisation meets the eligibility criteria? Well, if you're a LLP or a UK quoted company, you should already be reporting your greenhouse gas emissions as part of your annual return. But if you're a large unquoted company, this is new to you. So you have to meet 2 of the criteria shown here. Not like ESOS, which is 1, this needs 2. So you need to have more than 250 employees, a turnover of more than 38 million, or a balance sheet value of more than 18 million. Now this looks simple, but as I'm sure you're all aware, the devil is in the detail, or in this case, the incorporation point or the consolidation point. So consolidation is a term thrown around quite often. What that means is consolidated financial statements are the financial statements of a group of assets, liabilities, equity, income, expenses and cash flows of a parent company and its subsidiaries, so they are presented as a single economic entity. So when you're looking at group level reporting, you have to follow the same consolidation route as that taken for your annual accounts. So what this means is that when you're making your disclosure, you not only take into account your own information, but also the information of any subsidiaries included in the consolidation. However, you have the option to exclude from your report any energy and carbon information relating to a subsidiary where that subsidiary in its own would not qualify. So if it was a standalone subsidiary and it wouldn't qualify for SECR, you can remove that, but you will need to state this. So this is a very different approach to that taken from ESOS, where a smaller subsidiary of a parent company was not exempt, even where on its own it would not meet the qualification criteria. In ESOS, it still had to be incorporated. Companies incorporated outside the UK are not required to include their energy and carbon information in their director's report under this legislation. This includes foreign parent companies of UK subsidiaries. Where the accounts are consolidated outside the UK, then each individual UK subsidiary will need to assess their eligibility criteria and, if required, create their own SECR statement. So the last part of this, which is good news, is if you consume less than 40 megawatts of energy, you're excluded from the requirement to report your energy and carbon information. However, you want to put a statement to this effect within your director's report because it is very much a comply or explain mentality with this piece of legislation. So, SECR is effectively your organisational carbon footprint, with the addition of reporting your energy in kilowatt hours. My view is this is basically to allow alignment as we go forward with ESOS. So compiling a robust, repeatable and comparable organisational carbon footprint takes a little bit of thought and planning. At the front end, to gain the most effective results. However, the process can be broken down into 6 easy stages, excluding verification, which, although I would always advocate it for SECR, it's not required under this piece of legislation. So from the slides you can see stage 1 and 2 are all about defining those boundaries, such as consolidation approach, geographical boundaries, and where the sources of the GHG emissions are within your operation. I am using quite a bit of jargon here. We have got an element in this presentation that will go through common terminology, so be patient, we will get there. So it should be noted that for SECR, the Climate Change Reporting Framework, the CCRF, requests reporting on impacts from entities within the financial control boundary, categorised as Part 1, and the impacts of the associated reported as Part 2. This aligns with the GHG protocol, while also enabling emissions from investments in associates to be reconciled to entities and consolidated within the financial statement. It's all building up to a long pathway to where everything is going with the carbon footprinting report, your sustainable development goals, and the UK budget to get us down on the carbon. So this is why all these pieces of jargon are coming in. Stage 4, defining your quantification methodology. It sounds really simple, but here you need to look at what conversion factors you're using, what assumptions are permissible, and what data materiality. So how good is that quality data you're putting in? Stage 5, well, from my perspective, this is the fun part where we draw all the information together. We've herded all those cats and we start seeing the pictures and trends associated with your organisation. This can actually be very revealing. An example I can provide you with of this was the very first carbon footprint I ever did for a company was an engineering consultancy. And they spent about 2 million a year on travel. When we drew the carbon footprint together, we worked out it was actually close to 7 million. So you've got unproductive time. You can't work while you're driving. We also looked at the ROSPA health and safety statistics for the number of miles driven, and we worked out that we should have had about 2 to 4 accidents and 1 fatality, which was quite surprising. And then finally, because it was a carbon footprint, at that point we did look at number of trees that would need to be planted. It was still quite a new thing in those days. So we ended up with probably about 4,000 trees needing to be planted, according to the WWF stats at the time. So that enabled that then to start being rolled out globally for carbon footprinting. It changes the viewfinder. So this stage, you'll uncover all sorts of gems, including where your data process gathering needs improvement, isn't quite working for your business. So anyway, the last stage is completing your SECR statement and incorporating it into your annual director's report. This will need to be signed off by your director, and it will also need the engagement of your accountants, because ultimately they're the ones who will submit your financial return. So, what tools would you normally need in your carbon footprint? Just wait. I often talk about it as my tool belt. So the main ones I use when we're compiling carbon footprints is, my apologies, I've just had a little hiccup. So the main tools you'll need is, well, I'll always say sustainable footprints. Put us in your tool belt and we'll always help. But you're here because you want to look at doing this yourself. So the key documents you're going to need. I always work with the GHG protocol, the ISO 14064 standard, and the DEFRA conversion factors. The best way of looking at how these three interact is the ISO 14064 provides a framework, a skeleton of robust environmental emissions reporting. The GHG protocol figuratively puts the meat on the bones. It gives you more detailed methodology and explanations to help you and guide you in what you're doing. Finally, the annually updated DEFRA conversion factors facilitate the conversion of your operational data into kilograms or tons of CO2e. Also, very helpfully, they now provide kilowatt hours as well. So just to clarify though, the DEFRA conversion factors are for the UK only. So if you're doing this for other countries, such as the Republic of Ireland, America, etc., you may want to look at the country-specific conversion factors, such as from CEPA, EPA, or as a basis, you can always go from the IPPC. But these often will take a lot more conversion calculations than the units just provided by DEFRA. Other key tools and documents listed on this slide form part of your carbon footprint, and some of them are available for us if you don't want to develop your own. Now, understand, across the previous slides, I have mentioned that there's a lot of jargon, but from talking to a number of clients, we're all used to this jargon, but we don't actually understand it or often don't use it in the right context. So I thought it might be prudent just to go through some of this, with some of the terms you may be familiar with, and refresh everyone's understanding. If anyone wants to input during this, please send a chat, please join in. Again, I don't really want this just to be me presenting at you. So when we open the floor, I'd love to have that debate around these things. So it should be noted that the SECR statement is pretty much your annual carbon footprint. So the first one we're going to look at is when we talk about scope and boundaries. The scope deals with activities, facilities and decisions, and the boundaries delineate the physical processes or site limits and organisational limits. So just like with financial accounting aspect of your annual return, the scope and boundary needs to be clearly delineated and documented, as this forms the framework for the methodology. And if this is gotten wrong, it can severely impact your carbon footprint and your time. You can find yourself diving down all kinds of rabbit holes. So this is your ring fence of where you stop, where you say, we are only looking at this. Anything else? Someone else's problem. So if you don't do that, you just keep going. And what you'll also find is you will end up double counting, because where one organisation takes responsibility and you take responsibility, it's reported twice. We don't want to do this. This often happens actually when organisations start looking into supply chains and their shared services. So make sure your ring fence, your scope and boundary is really clearly stated and defined. So this leads us next into what our understanding of greenhouse gases and their scopes are. So when we refer to greenhouse gases, these are also known as GHGs. These are not just carbon, but include those gases controlled under the Kyoto Protocol, which include carbon dioxide, sulfur fluorohexafluoride, methane, nitrous oxide, nitrogen trifluoride, hydrofluorocarbons, and plurofluorocarbons. I feel I should take a bow at this point, just because those words are not easy to say. But when we talk about all of these, we use the term carbon dioxide equivalent, or CO2e, as a way of describing the different greenhouse gases in a common unit. So what that means is each of these gases has the equivalent, the global warming potential of X number of carbons. So we use carbon dioxide equivalents. With regards to GHG scopes, in short, GHG organisational emissions are batched into one of three scopes. The easiest way to understand this is to view it from a point of control. Control is often viewed as either financial, what you pay for, operational, what you manage, or equity share, the percentage attributable to any joint venture you may be in. Those are the scary ones, is joint ventures. So scope one is where you have full control. So I'm going to use the example of a company car. You select the vehicle type, what fuel source it utilises, how it's maintained, driver operation rules. You're in control of what happens. Jumping to scope 3 is where you have indirect control. So using the car again, this is where you reimburse your employees for mileage. They're using their own private vehicle for business purposes. So you control the requirement for the trip. You've virtually controlled the trip. But if your employee decides to drive a Prius or a Mustang, it's entirely their choice. Scope 3 emissions can also include things like water, waste, business trips, flights, accommodation, materials consumed, and your wider supply chain. The anomaly of the batch is the scope 2. This is generally attributed to electricity, heat or steam, and what this means is when we talk about natural gas, which is scope 1, we burn the natural gas to create the energy to use it. With electricity, the source fuel is burned elsewhere. So the fossil fuel is burnt at the power plant, and we just take it off the national grid with the mix of renewable energies. We don't control necessarily what source goes in. Yes, we control what we can buy, but we don't control what goes in. So as we develop our client SECR statements and supporting reports, we advise clients to include, to limit practicality, all of scope 1 and 2, and those scope 3 emissions, such as employee reimbursed mileage, water consumption, and waste, which we believe is more likely to be incorporated into reporting in the future. We also make great pains to align our ESOS and our SECR, because the last thing you want to be doing is collecting data. So with ESOS, we would collect reimbursed mileage. SECR, we'd incorporate that. So, as you can see from the breadth of aspects covered, carbon is much more than energy. Yet the number of clients I go out when I'm auditing, because we also do 50,001 energy audits, use the term energy and carbon footprint as interchangeable. And it's so common. So I want people to look at stepping away from that. The definition of energy in physics is the capacity of doing work, i.e. it's an input. The definition of an emission is that an emission is something that has been emitted, released or discharged. To put this into context, you utilise refrigerants in your air conditioning system. These are scope 1, but these don't create work done. They're just an emission that forms part of your carbon footprint. So looking at making sure you step away from using these terms interchangeably is a really good step to making sure what you build with your footprint is robust and doesn't just focus purely on your energy. For clarity, by the way, refrigerants are currently not required for your SECR. This is an example only. SECR requires your organisation must use verifiable data where reasonably practical. If verifiable data is not available, a reasonable estimate may be used. However, you need to document this estimate, including how it was made up, just to ensure year-on-year consistency. If the need arises for past energy use and emissions figures to be amended, and it happens, the correct figure would be presented alongside the original figure so you can see that comparatively. One of the biggest issues my clients experience is where to get data from. This will often need the input of a number of departments. Don't try to carry it on your own if you're the one pulling it together. I've often found actually a good place to start is accounts. They pay for everything. And one of the little rules of thumb I always got taught is you follow the pound, you'll find the CO2e. So source data, it'll often include stuff like your asset lists, meter reads, fuel cards, energy bills, expenses reports, purchase orders, production numbers. They fill a whole number of areas within your carbon footprint. So earlier we mentioned numerous data from different sources. This is where we use the term materiality. So unlike with ESOS, you were allowed a certain amount of de minimis. You were allowed to exclude something because the data might not have been great or it was such a tiny part of the business. It's up to 20%. SECR regulations don't actually give you any leeway for that. They don't make any statements around it. However, best practice, they do allow some emissions which would be 2 to 5% of the overall emissions or energy. With so many data sources, there's often going to be this high degree of materiality. And what this is data confidence. And believe it or not, this data confidence level can also be something you would look to improve year on year. So the easiest way to look at data confidence is the good, the bad, and the ugly. So good data would be 12 months meter reads, and this would give you a confidence score of maybe plus or minus 5%. You know it's good data. Bad data would be 6 months of estimated electricity bills extrapolated for the remaining 6 months that were completely missing. And this could be a confidence score of plus or minus 15%. You wouldn't want to start hanging your hat on this one. And then the ugly data, well, that would be walking into the floor area of your office going, oh, it's about 25 meters square. I think it'll be about this much energy consumed, and that's going to have a confidence score of plus or minus 50%. You look at each data set for this and you aggregate them together so your overall carbon footprint returns a confidence score. By determining this materiality, it allows you to target data collection improvement activities, and it also will help you justify if when your carbon footprint goes up due to improvements made in your data collection, I have to say I've experienced it where one year my carbon footprint looked very, very low, and the next year it shot up just because we now have a higher quality of data. And you want to be able to explain that. So this brings me on to intensity ratios. As your SECR statement is publicly available, reporting the absolute tonnes of CO2e does not reflect your organisation's performance effectively, or more importantly, fairly. So, for example, as a widget maker in year 1, you report 100 tonnes of CO2e. I know, not realistic figures, but there you go. In year 2, you reported 150 tonnes of CO2e. However, in year 2, you tripled the size of your business, both in revenue and production. You're rightfully proud that your carbon footprint didn't triple in size also. But as you report only in absolute terms, all the public can see is a carbon trend line increasing year on year. For this reason, it's vital you get your intensity ratios right and you put some thoughts into them. The terminology intensity ratio is another way of stating one of your business's key performance indicators. A trick to how to look at this is to look at how the wider business measures their success. So this could be tonnes of CO2 per widget produced, tonnes of CO2 per turnover, tonnes of CO2 per employee, etc. This is something your business will do, so finding a way of aligning this is vital, because it also will make sense for you to be able to set your targets against this year-on-year activities. It can also be used as a tool to gain organisational buy-in for your carbon reduction projects. When you start saying, you know, we're not just going to save this amount of tonnes of carbon per product, we're going to save this amount of pounds or this amount of energy. The second compliance requirement states that you need to put at least one intensity ratio included, and this metric expresses the business annual emissions in relation to a quantifiable factor that should be the most appropriate to the organisation's activity and be relatable and meaningful to stakeholders. So it's got to mean something to those people reading the report and a way of looking at your business. So we've covered carbon footprinting, but what should you include in your SECR statement? I've seen a number of cases where it's stated you should include all scope 1 and 2 emissions. I said we encourage our guys earlier about that. However, this doesn't actually align with the actual SECR requirements or what you did for ESOS. So to reduce the administrative burden, we would ideally like to align your carbon footprint reporting best practice and ESOS compliance activities where practical. SECR requires you include emissions from activities for which you're responsible for, including as a minimum the use of purchased electricity, combustion of gas, or the consumption of fuel for the purposes of transport. Taking transport, for example, the SECR requirements state miles reimbursement should be included. However, these are classified as scope 3 from the GHG protocol. Another example, as I pointed out earlier, is refrigerants. This is classed as scope 1 under the GHG protocol, but isn't required to be reported under SECR. One of the big queries is what happens when you're renting buildings or when you're a tenant. When it comes to the landlord-tenant arrangement, the guidance clearly states that the party responsible for the consumption should take responsibility for reporting it under this legislation. This includes consumption of energy in rented serviced areas, where a tenant would report on energy consumption despite not being directly responsible for its purchase. In the cases of energy where submetered information is not available, reasonable estimates should be included and documented. And I know this can pose a lot of problems just from when we've done footprints and ESOSs before. Often it's very hard to get some of that from your landlord. One way of doing it is to proportion it via your lease agreement and try and do a calculation and assumption from that. We have a few case studies where we've done that. So, before I go any further, and before we get on the home run, I must apologise for including Buzz in my presentation, but when I started developing this section, I could not get this guy out of my head. So here he is making his debut cameo appearance. So we're now at the stage where we've done the majority of the grunt work, pulling that carbon footprint and SECR compliance activities together. But there's still two key aspects that should be included in your year one that will also have a real impact on your subsequent reports. The first one is mandatory, and this is this is to document energy efficient actions taken. Excuse me again. These can be anything from installing smart meters and energy monitoring tools, converting your fleet to electric vehicles, changing your maintenance plan or behavioural change programs, through to capital investment projects such as installing LED lights or variable speed drives on machinery. The one rule here is that the measures have to have been taken in the relevant financial year. It can't be something you did 2 years ago, or it can't be something you're planning next year. It has to be in that relevant year. The second one is voluntary. And while SECR reporting requirements cover emissions and energy information for the current and previous financial year, organisations are encouraged to set forward-looking, ideally science-based emissions reduction targets and include statements to the effect within their SECR statement or supporting report. So the statements don't need to be highly detailed. They can be something along the lines of, our emissions reduction target is to reduce our tonnes of CO2e per product output for our scope 1 and 2 emissions against our 2020 baseline by 10%. Our current progress against this target has been reasonable, with our expectation that we will meet our target by 2025, with our managing director responsible for the achievement of this target. The wording and tone is very, very similar to what they would use in your accounts reports anyway. Remember, it's keeping that tone. Another example of this could be to target to improve your data materiality, or to incorporate additional scope 3 elements in your carbon footprint, such as waste and water. In short, stating a target publicly shouldn't be intimidating if it's based on a robust carbon footprint that you're satisfied you can stand behind. Targets should always be smart and meaningful, and can have the additional benefits of driving change and being publicly attractive. And remember, your targets can change as the business dictates. As the business changes direction, your targets can change, but it's that transparency and clarity with everything you do that is where you'll win the brownie points. So what does it mean for your year 2 onwards SECR reporting? So yes, folks, we all know it, annual carbon and energy reporting is here to stay, and it is going to become business as usual. So you will eventually be required to show that 5-year comparative. This is why getting this process and methodology right from the first year and compiling that robust carbon footprint is so, so vital. It's going to save you a lot of work if you get it right now. Heavy at the front end, light at the back end. If you do not have a third party to undertake this exercise for you, make sure you clearly document each step of your process for this, including where you got the data from and the assumptions applied. Try to keep it as simple as possible. Think about it like a recipe. Add 6 eggs, half a pint of milk, 10 grams of flour, cook for 20 minutes. Simple, as I can guarantee you, and I've had this from personal painful experience, that when you revisit this exercise in 12 months' time, if you do not document that process deep enough or in simple enough terms, you will spend an exorbitant amount of time trying to remember and understand what you did last time. It hurts. I've been there. Finally, verification. SECR doesn't currently require you to have a verified carbon footprint. However, this might be something worth looking at for a number of reasons, including, as this is a publicly available document, you want your stakeholders to have that reassurance. And it's actually another way of having that sanity check, another pair of eyes to give you that reassurance you've correctly herded all of those cats into a robust carbon footprint. We all know how easy it can be to get down the rabbit hole and you just can't see the wood for the trees. You're really lost because you've been working hard at this all hours of the day and night. So that extra pair of eyes can really give you some insight. Or you might just feel verification will give you an edge in the public's eye. against your competition. Your marketing department will love having another badge to tell all your clients about. There's a number of ways you can look at getting your footprint verified. As an ISO-based organisation, Sustainable Footprints would always recommend you gain certification from a third-party UCAS accredited certification body against ISO 1464. However, if you just want a fresh, qualified pair of eyes to give it a sense check, businesses such as ourselves would be willing to do that utilising the standards, the 1464 standards principles. There's other standards out there which can be used, such as the Carbon Disclosure Project, CMARS, Carbon Trust, or the Accountability AA1000, which uses accounting principles, or the Sustainability Accounting Standards Board, SASB, which we're licensed providers for. Both of which of these are used in ESG reporting. If you go down the verification line, I cannot emphasise enough from my perspective that it should be a UCAS or equivalent body, because otherwise you are paying for a badge that you could pretty much have just sat and designed yourself. If you're going to go down that line, do it properly. You might as well. You will lose more from using a non-UCAS accredited certification body than you will realise. So that brings me to the end of the presentation aspect of the webinar. I hope some of you are still awake. The next part of this webinar is an open floor, which we'll keep open for the next 30 minutes. After that, if anyone would like to see a demo of our SENCART tool, Hamza will be more than willing to do that. So over to you. Please ask any questions if you have any.
Sure. A question here. It says, how does the tracker compliance activities link in with our management systems?
I think if you're pulling together your carbon footprint properly, it all aligns with the standard ISO methodology. So if you looked at 50001, which is the energy management system, which a lot of companies will have, that standard itself asks you to do a full energy review, have intensity ratios known as energy performance indicators in that standard. It also asks you to have targets, action plans, clearly documented methodologies. So just doing the carbon footprint and the SECR compliance, or if you do it properly, will align well with the other management systems, and it should slot in very easily with your 50 and 14001. Okay, if we don't have any more questions, I'm just trying to move the next slide forward. If we don't have any...
I did have a question, but I was muted.
Oh, okay, sorry, Asterly.
That's okay. Just to confirm the deadline date, when was it again, please?
The deadline date is based on your financial year end.
Okay.
So if you have a April to March financial year at the moment, and you didn't apply for an extension, then it's late. If you did apply for that extension, then you've got till March, because that's 9 months. The rule of thumb is 9 months after your normal year end date.
Okay. So it's not a lot of time left then, is it really?
No, there isn't. It's
No.
If you've got annual reporting periods, you have. I think with the pandemic last year, a lot of companies, this might have fallen through a lot of the cracks.
Yeah. Understandable. Oh, thank you for that.
My pleasure. Okay then, so if there isn't any more questions, we've reached the end of the webinar. I hope you've enjoyed it as much as I have presenting to you. I have to say it's quite weird talking to my screen, but a recording of this will be posted to you on our YouTube and available on our YouTube channel in the next couple of days. And we'll email you a copy of the presentation and a web link to this, along with a performance survey. Your feedback is vital to us. We're really keen to make sure you want to come on these webinars and you actually get something out of them, not just having background noise. So please complete that survey in as much detail and constructive detail as you can, return it to us. I hope you'll follow us on social media, as this is where we release any new updates, tools and brief sheets. We have got some funky free tools that we let out there. And if you have any further questions, please don't hesitate to contact either myself, Claire or Hamza, or any of the Sustainable Footprint team directly. And I look forward to speaking to each and every one of you individually at some time in the future. Thank you very much.